Hi, Paul here, Property Apprentice. I'm stepping in for Debbie this week. Just wanted to run through a few things that I have seen in the market over the last little while. And I think this is something that we all need to be aware of. You may or may not have seen the Westpac research paper that came out. Their economists are expecting New Zealand to outperform Australia economically over the next few years. There are a few reasons for that, and there are implications for investors and home buyers in New Zealand. First, as we remember, there was a bit of a brain drain and Kiwis left for Australia as the grass looked greener. But with lending conditions tightening in Australia now, funding becoming harder to access, it will be tougher for people to buy. And I think there will be a lower growth rate in the homes over there as well. The other thing what would happen is this could mean there'll be some people coming home because the grass wasn't as green as they thought. And if we look at a couple of weeks ago, Sydney's median house price value now sits at 1.7 million Australian dollars. And, we think it's expensive here. So it doesn't really matter how much more the income is. Another, for Auckland, $800,000 is median value on top of what it is here is a lot of money. So I think now New Zealand is definitely moving into the next phase of the economic cycle. The Reserve Bank has dropped the official cash rate again this month. And over the last year, we've seen about 250 basis points of cuts. And there's a likelihood of another 50 basis points. This is what the Reserve Bank has hinted at that they're looking to do before the end of this year. That easing will help boost domestic demand and unemployment in New Zealand. By contrast, if we look at the RBA, the Reserve Bank of Australia, they have tightened more gradually. They've only cut 75 basis points since the start of this year, and their lending conditions remain mildly restrictive. So Australia is like to see modest growth, and New Zealand is expected to return to more normal levels of growth and even a stronger per capita GDP growth over the coming years. Westpacs are expecting the official cash rate to be at 2.5% by the end of the year, which goes in line with what the Reserve Bank said. Totality has also said that there is an affordability window right now for housing, and our affordability sits at about 44% of median household income, the amount that you need to service a mortgage. Now, although that still sounds a lot, it's actually down from 57%. So it has dropped quite a way, which makes a massive difference. And if we do get those extra two official cash rate drops, that affordability, if the banks get to pass some of that on, will actually get better. So people are already thinking that house prices are increasing, so that window will close at some point that we're seeing right now in the future years from here. So if you think about the boom that we had, and I think the media does a great job of reminding us how much house prices have dropped since 2021, but you really need to put it in perspective of the government spending that we had, the triple CFA, the official cash rate going up, increased due to inflation. That was due to a lot of government spending. But if you strip that out and you take out that peak of that market and you put a ruler on, say, from 2015 to 2025 now, and you put a ruler line, we're back on that natural growth line had that have not happened. So I think we're back to where we should be as if that boom never came along. So what does this mean for you? I think investing or home buying or upgrading, whatever it is for you, over the next 6 to 12 months will be good, but you need to be thinking about that now and at least getting financial advice sorted so you can hit the ground running at the time that your financial position allows. And obviously that is something that we help our clients with. So if you're interested in coming to one of our free events, then just go to propertyapprentice.co.nz and come to one of our free events. And you can also book in a meeting to have a chat with me anytime as well. So don't wait until the next couple of official cash rate drops have been locked in before you jump to the market, because by then I think a lot of other investors will be back in as well. And we're already seeing that increased demand from the first home buyers and investors getting back into the market. But as the cycle turns, you want to be ready and raring. So please do come along to one of our free events. That's been helpful. Look forward to catching up with you again soon.